time and meeting. Any questions on the meeting, guys?
All good, Ayman. Going.
Perfect. Let's move on. Okay. Another statement by Ben. In the short run, the market is a voting machine. In the long run, it is a waiting machine. Every day, someone is voting, yes, this stock is nice. No, this stock is going to go down. You'll find analysts saying, oh, buy, hold, keep it, do this, do that. It's a voting machine all the way in. At the end of the day, in the long run, it is a waiting machine. The more that you accumulate, the bigger it will go at the end of the day. Let's talk about some definitions. We're going to start with these basics. Stock. It is a share. It is a piece of the company that you own. You can own 5, you can own 10. Obviously, the company has to be what we call publicly listed, which means it can be traded in the exchange market. Company as well may decide to say, okay, I've done well this year. I have extra cash. I'm not going to use all that cash to do anything. I'm going to give you part of it. So I'm going to highlight. I'm going to say for every stock you have, I'm going to give you $1. This is what we call a dividend. They announce how much it is and when they will give it to you. For Microsoft, the dividend is distributed every 3 months. This is where you get the dividend, the cash value in your ESPP, if you have your ESPP, or if you have in your Fidelity or Morgan Stanley account. A ticker is just a symbol that refers to that specific company. So Microsoft, MSFT. Index is a sampling of a specific group of stocks. So for example, I can have index to refer to the US market. I have index to refer to the US big market or middle market or small market. Or I have an index that refers to the health and the health market or sector, or the IT sector, or the whole world. So basically each one of these is just a sampling representation of all the companies in that specific sector, in that specific territory. A fund is a collection of stocks. If a stock is a flower, then the fund is a bouquet of flowers. As simple as that. A fund can be who's going to select these stocks in that specific collection. Maybe a fund manager will do, so someone who's going to be clever enough to say, yes, I think I have a theory, I know exactly what I want to do, I'm going to get the following companies to put that in that fund. This is what we call a managed fund. The other way of that is a passive fund, which is basically rather than having someone to pick and choose the stocks within the collection, basically that fund will follow one of the indexes that we discussed. So you have that index. It is a representative of, let's say, the whole world, include 5,000 big companies, and that fund will cover all of these companies. ETF is just a fund which you can trade as if it is a stock. So you can buy it online or on the platform from the broker account. Whereas if it's a managed fund, it has to be sold. Normally, it has to be sold through a saving plan from your relationship manager or from your financial advisor. This is a very quick comparison between mutual fund or managed fund, index mutual fund, because there is some managed fund that are index as well, ETFs and stocks. Very quickly, from a diversification perspective, funds is only the one which is diversified. Stocks obviously is not. Traded on the exchange, ETFs and stocks, intraday pricing, so during the day, you can get the price. Whereas these guys, they need to wait until the market close, then they will value what is the closing price for each company, and that will be the price of that bouquet or collection of stocks. Management fees, again, for funds, average is around 1.4%, 1.4%, whereas for ETFs is as low as 0.07%. Stocks, obviously there's no managed funds. Commissions, you get commission because you are trading on the platform. Here, there's no commission, but it is already inherited in the fees. Tax management, again, index trading, these two guys. Bonds, we quickly touched on that previously. Again, a government bond is something, let's say, government of Egypt will say, I'm gonna issue a bond. That bond is $200,000 each, and it is for 50 years, and I'm gonna pay you, which is a bond coupon, I'm gonna pay you 9% every year on the dollar. Yeah. Obviously, there is a redemption date for it. Credit rating as well, depending on who is issuing, you'll have specific organization that will give credit rating. You'll find, for example, Microsoft, for example, have a credit rating of A+, whereas, again, I don't know, Egypt, again, is credit rating of C or C- or something like that.
I think it would have to be.
Whatever the scenario is. I mean, at the end of the day, there is a risk associated with any bonds, because basically, if the organization or the company get busted, yeah, basically they cannot pay you any coupon, and that coupon is useless. Yeah. But they will try to pay the capital of the value as much as they can. They will liquidize assets and so on. I don't want to go through a lot of details, but at the end of the day, there is also what we call, typo here, bond ETF as well, a collection of bonds. Okay? Stock exchange, broker trading platform, and currency exchange. Very quickly, I think we are all familiar with the stock exchange. It's a place, we also called, again, this is Wikipedia, for security exchange or Borsa. Again, a place that you can exchange. Again, main stock exchange, New York, London Stock Exchange, Nasdaq, local stock exchange in Egypt, in Bombay, in Dubai, in Abu Dhabi. Normally, the local one normally trade with the local currency, the local companies. So if you want to trade in the local market, you need to have an account with these, and normally you go to the bank to do that. The broker is basically, in order to start trading or getting or buying stocks, you need an account with a broker, which will provide to you what we call a trading platform. There are multiple online brokers like Saxo Bank, like Interactive Brokers, and so on, which mainly support the main markets. To trade a local exchange, normally you need a local broker, and normally that is provided through the local bank. So again, in UAE, you need to go to ENBD, you need to go to one of these guys to be able to do that.
This is not the case in Egypt.
Sorry?
This is not the case in Egypt.
In Egypt, there is also brokers.
Yeah.
There is the same topic of brokers. But I think HSBC as well provide a trading platform, but I'm not sure.
I haven't heard that HSBC is providing any trading.
HSBC provide what is called HSBC Invest Direct, but it's not a very common one. Generally speaking, if I would recommend, again, I'll give two examples which I work with very quickly. Saxo Bank, yeah, very common here in Dubai specifically, and worldwide as well. Interactive Broker is the second one. My feedback on this is, again, from a simplistic perspective, Saxo Bank is much simpler, much cleaner, I would say. Yeah. Whereas Interactive Broker is a bit confusing from a user interface perspective, I would say. Having said so, if I did a quick comparison, and I'm gonna quickly go through this, yeah, very quickly, Interactive Broker is the cheapest worldwide. I was with Saxo Bank, and then I moved to Interactive Brokers recently. The cost of trading as well can be very high. Yeah. So the only thing about it is that the user interface is not that great, I would say. Yeah. The second part is, okay, now I have an account. How can I transfer the money to that account? Obviously, you can transfer through the bank. Wire transfer, normal wire transfer. Having said so, rather than doing that, we should also consider what we call the currency exchange countries, like UAE exchange and Ansari, UAE.
I think a fee on top of whatever you're going to do.
Still, these guys are the cheapest as well, UAE exchange. If you engage in what we call the club executive account, exclusive account, they will give you the best rate, and I'm going to talk about that. And the fees is a fixed fees. The math has been done. These guys are the cheapest. Long story short.
I think the fastest and simplest would probably be the debit card.
Yes, that's true, but it's not all trading account support that. So not all of them. You have to wire transfer to the bank, online banking, and follow the normal steps. But again, the problem with bank is exchange rate can be very expensive, and fees as well can be expensive. No. If you are transferring, because it's going to be wire transfer. Even if you use your debit or credit card, Saks Bank can enable credit card payment. The rate is going to be extremely expensive. Extremely expensive. The other ones are the online currency exchange as well. I personally started using the UAE exchange, and they are very, very useful, very good as well. They provide a very good rate.
Do they have an online?
And not an online, you just go and fill a form and so on. And yesterday I called the guy, I said, I want to transfer some money to Egypt. What is the rate that you have? Give me the rate. Yeah, he gave me the rate, and I just transferred the money from ADCB. It transferred today, they take the money on the same day and transfer that directly.
Okay.
So I don't even go. It's online banking transfer to.
Okay.
So it's very useful, I would say. It's my experience so far is really good. Okay, a few other terms. I don't want to go through a lot of details, but you'll hear CFDs, you'll hear futures, you'll hear bargain, you'll hear structured notes. There is a lot of other terms. I don't want you to get confused at this stage, but the basics are exactly the same. Let's talk about foundations. This is a very important slide. If we looked at risk compared with your investment, how it looks like. At the bottom, where it's very safe, is your cash, your accounts, your insurance, your treasury security, some of the treasury security bonds, government bonds and so on. All of that money that you leave in the company. So all of that are relatively safe. The way that you go up, the more risk it becomes. So, for example, the next part is company bonds, government bonds, high-grade bonds, fixed interest security. And then you go to that stock market stuff. Yeah, I would put ETF slightly in between in here. Yeah, and then you go on the top, this is your speculating stuff, buying art. Picking a stock. Yeah. So again, the higher risk, obviously the higher reward. Yeah. But it's always a comparison between risk and gamble. And from a definition perspective, gamble is just throwing your money in something that you don't know whether it will win or not. You just hope you will win. Whereas risk is a calculated. You calculate the risk, and based on that calculated risk, on uncertain outcome, you can hope that there is some money coming out of it, based on my calculation, based on the strategy that I take. And the bigger the risk, the bigger the reward. But also, the higher the climb, the harder the fall. Yeah. So keep that in mind as well. Yes, there is risk. The question is, how should I manage that risk going forward? Let's start talking about picking stocks. And picking stocks for me is exactly like this. Playing dots. Yeah? Examples. So this is a very interesting statistics about the number of stocks that beat the market, the Russell 3000 from 1983 to 2006. The story is so we have 3,000 stocks in that market. 64% performed lower than what the market did, whereas only 34. So if you are picking that dart, trying to shoot, your opportunity to hit one of these is double the opportunity to hit the 36%. Even if you start to include the other 0 to 5% and 5 to 10%, this is relatively the majority of the market. The remaining market is really very small. Yeah. Another question that you should ask yourself, are you cleverer? Are you cleverer than the fund managers? This is a snapshot of a graph from Common Sense Investment from John Bogle. Basically what he's saying is, from 1970 to 2005, at 1970 there was 355 fund managers, different funds, collection of stocks. And they have a guy who said, yes, I'll buy this, I'll drop this, I'll buy this, I'll drop this, or increase my, so. By 2005, only 132. If you look at overall, from a survivor perspective, only 21 beat the market by 0 to 1%. 15 out. If you look at 4% of above, we're talking about 2 or 3. Out of the 355. So if you look at over 1% and above, you are talking about 24 manager from 355. And they didn't beat the market by a lot. They just bet the market by 1 to 4%. The point is, you cannot beat the market. Even if you try, you cannot. Yeah. So another thing as well is, okay, what if I want to choose a specific fund, which is index fund as well, a passive fund? Again, another one that tells you the progress of the different funds through the years. So the bigger the bubble, the bigger the impact at that specific year, or that 10 year, or that decade. So in the 1950, for example, everyone but US was doing really good. In the 60s, the US small and medium was doing much better than the large, and so on. So again, even selecting the right fund or the right passive fund is not that easy. The recommendation is, don't try to buy a specific fund. Maybe what you really want to do is just buy the whole world, the economy, the whole market. There is a very nice ETF called BWRD from Vanguard, from John Bogle. Basically, it contains everything, all the markets. And this is what brings us to diversification. Again, we all know the code. Don't put all your eggs in one basket. This is the point that diversify as much as you can. This is another statement, another quote as well from Bogle. Don't look for the needle in the haystack, just buy it. Buy the whole haystack. Let's talk about costs. This is a very important one as well. Again, we all know the beauty of compound interest. How your compound interest can build a lot of money at the end. But also with the compound interest, you have the compound cost effect. So have a look on this. 8% before cost, 5.5% after cost. If you started by 21,600, yeah, in 50 years, that becomes 470,000, whereas after the cost is only 145. I have some real examples at the end with some of the saving plans from HSBC as well. This is another example as well from the index fund versus managed fund as well. Exactly the $10,000 being invested, one in an index fund and the other one in a managed fund.
Can we go back to the previous slide? What kind of cost that can slash 469,245?
That's only 2.5%. Just 2.5% can do this.
2.5%?
Yes. I'll show you the Excel sheet at the end. I'll show you the Excel sheet at the end.
Yes, I understand.
Yeah. This is again using index fund versus managed fund on the same category, the Dow Jones or whatever the scenario is. But again, give you an idea. If you invested that at the end of the 20 years, 25 years, you will only give 8,400 to Vanguard and take 170 back home. Whereas, and the other one, you'll give them 81,000 and give back and take back home only 98,000. It is impressive. Yeah. So, let's talk about cost. How can you optimize the cost? There's two parts of the cost. First of all, the trading cost, the commission that you pay when you buy and sell. There's also the custody cost, which is if I'm leaving my portfolio, let's say with Interactive Broker, how much would they charge me to keep it? So let's say I have $50,000 in there. How much do they charge me anything or not? Yeah. Saxo, for example, would charge 0.12% annually, whereas Interactive Broker is 0. So these two are managed by the broker. This is why selecting the right broker, again, keep in mind cheap plus simple equals superior. Yeah. Selecting the right broker can help you to optimize that cost. Second part is exchange rate and transfer fees. The same point that we were just discussing a few seconds ago. Using a bank with, let's say, for a USD dollar of 3.8% compared with 3.6732, that extra percentage, although it looks very small, but build up with the big numbers. Again, this is where we select the exchange, currency exchange provider. And finally, the fund management. This is where you need to go with Index ETF. Example. Okay. So this is something that I have done recently. So the best rate that I've got is 3.6735 from UAE Exchange. Yeah. Hidden, if there is any hidden bad cost, you need to add that like 3.8. UAE Exchange commission, that's $14.29, which is 42.5. It's back office transfer $25. ETF management fees is 0.15. This is the ETF that I'm currently using. IB broker transaction fees is 0.05%. Minimum is 5. IB broker annual fees is 0. Saxo is 0.12. Now, if you're trying to transfer $1,000, this is another question about how often should I transfer the money as well. You need to think about that. Should I, every month, should I send out $1,000 and do that? Or should I accumulate, let's say, 5,000 and send it? You can do the math and choose the cheapest. 1,000 trading fees, 0.5, minimum is $5, so overall 44.29. This is relative 4.4% as a one-off. Add the management fees, $1.5 a year for that $1,000, then the total is 45.79, then we come to 4.6%. Whereas if you transfer 5,000, it will cost you only 1.2%. Wow. If you added the exchange rate of 3.8 that you will get from the bank, yeah, then basically that 3.8 will cost you an extra 3.3%. you may start to think about, I'm over-engineering this, which yes, can be true, but I'm also answering that question about how often should you invest. Because the main idea is to minimize the cost. Because you saw the graph, the 2.5%, how that is accumulated. The two greatest enemies of equity fund investor are expenses and emotions. Yeah. On that, let's talk about emotions. This is the normal behavior. The market is going up. The guy bought something at this level on. He's very optimistic. It's going up. I'm brilliant. I'm doing great. I'm beating the market. Yeah. Then suddenly, the euphoria comes, and then it starts going down. Denial, fear, depression, panic, and so on, and start selling. Whereas at this point, this is the point that you should invest. But he doesn't know. He thinks this is going to continue to go down. And then it goes back up again. Because he just sold depression, then hope, relief, optimism, and so on. Let's talk about timing the market a little bit. I think we're doing right with the time. Anyone want to have a break or something? Okay, let's finish very quickly and move on. Meet Bob, the worst market timer. This guy has invested $6,000 in December 1972. Just before the crash, he lost 48%. Then invested another 46,000 again. Just before the crash in August 2007 and 1987, lost another 34%. And then December, same story with a bigger amount of money. And October 2007, before the recession, another 52%. So total invested 1984. When he started in 72, he wanted to retire in 2013. 30 years down the line, 40 years down the line. How do you think this guy did? Yes, he retired with $1.1 million. But the trick is, he didn't sell anything, which is really hard. He didn't sell anything. He didn't sell. He kept the money. If he stays, which is, by the way, an average of 9.5% annually, despite the big crashes. Despite the big crashes. If he waited until 2018, that 1.1 million would be 4 million. Nearly. Yeah. It's not timing the market, it's time in the market. Okay, let's talk a lot about fighting your emotions with discipline. I hope you like my presentation skills. Yeah.
They're very good.
I spent a lot of time with that. So yeah. So how do you do that? First of all, regular purchases, which is what we call dollar cost average. So exactly what we do is ECPP. You save 10, 5, 10, 15%, whatever the percentage is, every single month. And then buy once, which is every 3 months, to reduce the cost as well. Yeah. Never use margin, which is the broker loan. Need to ignore Mr. Market. Don't think about if the market is going up or going down. Never time the market. Never sell, and balance twice a year. I'll talk about balancing in a second.
So regular purchases. So what about, like, you know, some of us get bonuses, for example.
Yeah.
We get a relatively bigger.
Yeah.
So fine with that as well?
Well,
Or discipline is about having a schedule to say, this
Yeah.
year I'm only investing 30,000 in ETFs every year.
Yeah. Well, for me, for example, what I do is, again, I look at the bigger portfolio, which is I have around 25% cash and 75 in the stock market. So let's say you get a bonus. As soon as you get the bonus, and you need to balance that to return that back again to 25, 75, you take that bonus and just go and invest that.
Okay.
Now, when you invest it, you need to invest it in your portfolio, which is balanced itself.
Yeah, of course.
Yeah. So, but yeah, when you get a bonus, go and do it. There is no reason that you should say, oh, let me wait until the market crash.
Yeah.
Yeah. So the fact that let me wait until the market crash to put money in,
Could be a 10-year wait.
maybe. Another example about the dollar cost average. Again, the line in gray is $1,000 invested in Spider, which is the US market, on the 24th. That started going down and up, as you can see, and end up somewhere around $80 or $150. Whereas if you split that $1,000 across multiple 128 monthly installment, it gives you better impact. It reduces the crashes in a way. So even if you are having a crash in you wouldn't see that. But again, back to your point, if I get a lump sum at some unexpected lump sum, what should I do? Again, multiple statistics says go and use them directly. Balance according to your strategy, your cash versus your investment, and push it directly. If it goes to investment, go to the investment.
That doesn't make sense.
Yeah.
So you're saying the gray line is you invest $1,000
and do nothing. Put the 1,000 and do nothing. Whereas this guy actually didn't have the 1,000, so he said, I'm not gonna wait until I get the 1,000. I'm gonna spend 120. Sorry.
$7 a month.
So basically, I'm gonna split the 1,000 by whatever 10 years or whatever the scenario is. Yeah.
Okay.
Sorry, apologies, my mistake. $7.8. Yeah. So $7.8 every month. So rather than waiting for 1,000 and investing it, I'm gonna invest $8 a month.
Yeah.
Yeah. Which again, I end up investing the $1,000, but I invested them across the years. And your investment plan should be exactly the same as well. Another graph that tells you about putting a lump sum versus dollar cost averaging, and it is for the dollar cost average in general. But again, if you have an unexpected lump sum, just go and push it.
Or continue with the dollar cost
Yeah.
averaging.
Yeah, and sometimes possibly rather than investing it all in one go, maybe it's a high risk for you to put, let's say, $10,000 once, then put just 5,000 and later do another 5, hedge it. Yeah, so do whatever you feel comfortable with from a risk perspective. Yeah. Investing is not about beating others in their game, it's about controlling yourself in your own game. Let's talk about tax, which is, in my mind, the hidden cost. There is two specific tax, because the majority of the market is US market. There is dividend tax, and there is, and many people don't know that, estate or inheritance tax. It's very important for Microsoft employees as well. Okay, dividend tax for any US company, it is applicable. So let's say, again, Microsoft will give you $1 for each stock you have. They will take 30% upfront. Fidelity, before it gave you the cash in your account, will take 30% and give that and again, whether it's 30 or 15%, it really depends on your location. If you are based here, based in Europe, if there is a tax treaty or whatever the scenario is. The second one is estate inheritance tax, and this is very interesting for non-US citizen and non-US residents. The inheritance tax is a tax applied after your death on the stock that you own. If you own a US stock, like Microsoft stock, you have an exception up to $60,000. Anything over the $60,000 is taxed at 40%.
I don't think it matters the stock that you have, whether it's a US stock or not. What matters is the platform that you're investing on.
No,
so
no,
if
no.
it's a US.
No. It's not
If I have a stock that is not a US stock.
Fidelity, no.
I
No, this is low. No, it applies.
if the investment is in the US,
No, no.
it applies, irrespective of whether the stock
Now,
is a US
if
stock or
the
not.
US company, if you own a stock in a US company,
In a
let's
US
say,
company.
yeah,
Yes.
if you own a US stock company like Microsoft, let's say $100,000, you have something worth of $100,000, yeah? And then, God forbid, you die today, then the first 40% is tax-free. The remaining 60%, which is 60,000, they will tax that at 40%. So they will take 24,000 and give you back the remaining.
That's irrespective of the stock, whether it's a US stock or not.
No, no,
It applies.
No, no,
If
no,
I'm
no, no,
holding
no,
the
no.
stock of BMW, that's a German stock.
it doesn't apply.
But it's in a US company.
It
Like
doesn't
United-
apply.
Doesn't apply.
Doesn't apply.
It's only on the cash. with
On the cash,
broker.
so if you have cash in that account, then yes, it applies. But if you have a
German
German,
stocks.
Yeah.
And the stock is not a US stock.
Yeah.
And it doesn't apply.
yes,
Okay.
okay?
And this is only in the.
Something else applies. You need to check the German law.
So I'm just worried about the time. This is a big topic, so let's keep that for a second. This is why we are saying always buy what we call an index ETF, which is not based out of the US, based out of Ireland, for example. Yeah, to avoid that. Yeah, obviously the exception is US and Irish citizen. Other consideration, very quickly, because of the time constraint, I want to quickly go through that. Maybe what you need to think about as well is rather than opening a single account, open a joint account, just in case. Yeah. Again, it doesn't affect, but it can help. Maybe joint offshore account as well, so that if you decided to sell, you can move the money again to that offshore account outside of Egypt and outside of UAE as well, and outside of US. Some people do this. Again, I wouldn't recommend, but it's totally up to you. Again, you can tell your wife as soon as you pass away, someone needs to go in and sell everything and move the money out and leave the account, which can be done as well. This is excluding any capital tax. So people living in Europe, they need to be, and US, they need to think about that as well. In the UK, for example, we have something called ISA accounts, which is whatever capital you get, you don't need to pay it. In the US, it's even more complicated, but anyway. Maybe another idea is to build a trust or a company and put the whole thing inside it, and then it's a company. It's a more complex scenario, but it's worth having a discussion, especially if your portfolio is growing bigger. Yeah, but all of these are stuff. Again, I'm not a tax advisor, but these are things that you need to think about and get a proper tax recommendation. Okay, I'm just worried about the time.
No, we want to talk about this one.
Yeah.
That's why we're here. That's why we bought tickets.
Let's talk about let's talk about that. Okay, so let's talk about something called asset allocation strategy. Again, if you have a portfolio, then there is a question about what should you put in that portfolio. Some people will put some properties in it. Some people will put stocks, cash, bonds, gold, whatever the scenario is. Generally, the question is, which asset should be part of my portfolio? What ratio should I use? And how can I do balancing? And let's start with balancing first. Let's say that you have a 50-50 portfolio. 50 in stocks ETF and 50 on bonds ETF. So I have $10,000, put 5,000 here and 5,000 here. 3 months down the line, I have $2,000 I want to invest. And guess what? The market went up. So basically the stock did better than the bond. So I get this 2,000, I balance with that 2,000. As simple as that. Why? To return back to the 50-50 strategy that I have agreed to do at the beginning of this engagement or in this.
What if the stock went up?
Then it's the other way around. The idea is, that's a very good question. So why am I buying bonds, by the way?
Why am I buying bonds? Because bonds are cheaper. So buy low and keep it. So the idea here is you normally go and buy the underperforming, because at some point, if the stocks start going down to crash, normally the bonds will go up, and I'm going to talk about that in a second. So bonds is normally, as a behavior, is inverse to stock. If stocks are going down, bonds will go up. Yeah. So in this scenario, bonds will go up. Then what to do? Then the stocks are cheaper. Then you get the 2,000, buy stocks, and so on. So this is the question: why bonds are important in your portfolio? And I'm taking that example just to show you. The line in blue is bonds. The line in yellow is the stock market. And basically, if you have a mixture of these two, depending on the ratio yet, it's smoothing the actual behavior later on. So rather than dropping, let's say 50 or 60%, you only drop 40%. You only drop 30%. If you have the right mixture in, then that drop in the stock market, which will happen and it will continue to happen, but also mentally for you, it's better to have that, let's say, easier ride as well. Generally speaking, bonds are considered what we call stabilizing anchor. Normally it is inverse to stock. When the market crash, bonds goes up. Also, when the market crash, golds go up. Gold as well, price go up. It minimizes the volatility, as we said. Fixed income, you know that every month you will receive that amount of money. It's given. Yeah. It's safer if you are getting it from a well-known organization, plus A or something. And normally many people use it for pension as well. Yeah. So rather than selling and stuff, they can convert all their portfolio or majority of their portfolio to bonds and just stay on the fixed income or the money coming out. And this is where we start talking about the stocks and bond ratio. Again, as a recommendation, in your early life, majority of your portfolio should be on stocks. As you grow older, you start to move toward the bonds. Yeah. How many ETFs should I have? Normally recommended, you should only have 2 or 3 maximum. Why? Again, to minimize the cost. So it affects the cost, it affects the complexity, it affects effort as well to do the balancing every time you have money. So example, just very quick example, if you have 1 stock and 1 bond, you sell the bond, that's $5, purchase the stock, that's another $5, total cost is 10. Whereas if you sell the bond 5 and then purchase 3 stocks, that's 15, that's 20. Again, very simplified, but the point is, don't go in a journey to every time I like this ETF, let me go and buy it. I like this ETF, let me go and buy it. Before you start, you need to sit and think about which ETFs you should use. Which is our next question. Very quickly, low cost, index, and Irish for non-US. Some highlights, VWRD, we spoke about that early on. Again, very low risk, extremely diversified. Average return is 9.99%. Again, across the last 20 years or something. As you can also see, majority of it as well in the US. Yeah. And it has nearly over 2,900 companies. Another one is for bonds ETF. This is the one which is the global government bond ETF. And this is another one for the USD Treasury bonds. Yeah. Okay, let's talk about portfolios and ratios. This is a simple one. 90% in VWRD and 10% in VDTY. Yeah. You can change that. The ratio itself is really up to you. If you are not comfortable about having 90% in stocks,
because you still see that as a risk, then go with 50-50. Go with whatever. Just give it a try, I would say. Yeah. Ideally, early stages, accumulate a lot on this. Another twist to this is, another way to do this is to use your age. So for example, let's subtract that from 100. So let's say you are 40, then stock to bond is 40 to 60. Another way of doing it. If you don't know, then that's another way of doing it. Another twist to this is to think about where you are going to retire. And when you start thinking about where you want to retire, you need to also to make sure in your portfolio you have something related to that country. So, for example, I'm going to retire in the UK. I want to make sure that my bonds or some of my stock market is following the inflation in bond in the UK. So what I will do is I'm going to put 40% in British bonds, 30% in in BWRD, and 30% in my British stock ETF. So that gives me a more toward the UK economy. So when I retire in 30 years' time, again, my performance is equivalent to whatever that place is. I had two other examples, but for the sake of the time, I hid them. So I will unhide that and send that with the slides. Let's talk about retirement very quickly. Why we want to talk about retirement?